cash secured puts video you are ever going to have to watch. Hey guys, Corey here. Welcome to the channel. If it's your first time, be sure to subscribe and tap the bell so you know when I post new videos like this. And of course, give me a thumbs up as it greatly helps the channel grow. Cash secured puts are just one of the many strategies in the stock market, and it can be very difficult and risky and takes a very long time to get good at investing and trading and understanding everything. One small mistake and you can lose a lot of money. It took me years to learn how to do this the right way. I went to college and spent years doing this and had some serious losses in the beginning. However, I became profitable and I grew my portfolio and my understanding of the market. And I told myself when I achieved financial freedom, I would help others. So if you're having trouble understanding the market, understanding trading and investing in general, and you're looking to grow your financial freedom and wealth, I am offering one-on-one coaching, full training course, and Discord. And you guys can sign up at any time at investorscorey.com right there on the screen or in the information box below. I also just launched my masterclass bootcamp, which is even more advanced, and you can also sign up at the link as well for the bootcamp. Very limited spots available for that bootcamp. If you guys are really looking for financial freedom and time freedom, location freedom, and just overall security that you deserve, I would love to be your one-on-one coach and help you guys achieve your dreams and the financial freedom that you ultimately deserve. So what is a cash secured put? Well, a put is an option, just like a call. In this video, we're going to talk specifically about puts. In every contract, you have a buyer and you have a seller. There's two people for every transaction because someone is writing the transaction, selling it, and the other person is buying the contract, the buyer. So like I said, you have a seller and a buyer. And in this video, we are going to talk specifically about the seller because we are going to be selling puts. Now, if you are buying puts, that's for a different video. But when you buy a put, that's a long position and you're hedging your portfolio in case the stock goes down. You, as the buyer, have the right to exercise and sell your shares at the strike price of the put, no matter where the stock price goes. If the stock price is $50 and you buy a $45 put and the stock price plummets to $10, you can still sell your shares for $45. But as a put seller, we are writing the contract to the buyer who has the ultimate right to exercise if they want. We, as the seller, are obligated to purchase the shares from the buyer if the stock price goes below the strike price of the put. So for example, on Nvidia, if the stock price is $130 and we sell a $120 put and the stock price falls to $119, we are obligated to buy the shares at $120, even though the stock price has fallen to $119. There's a benefit to this though, because ultimately as sellers of puts, it's different than a buyer. A buyer buys a put because he feels the stock is going to go down, whereas a seller of a put sells the puts as insurance because we are expecting and we feel that the stock price is going to go up. So it's a bullish move to sell puts. It's also a very safe strategy because when you're buying options and they expire worthless, you lose all of the premium you paid. Whereas when you put up cash collateral for a cash secured put, the worst case scenario is you buy the stock. The money's not completely gone. So cash secured puts is actually one of, if not the safest strategies you can implement into your portfolio. So what's really cool about selling cash secured puts is when the buyer feels like the stock is going to go down and you know it's not, you're collecting all that juicy premium just for yourself. Oh, you think the stock is going to go down? Oh, you think Nvidia is going to go down to $115 or something? Okay, I'll sell you $120 put. Thank you. I'll take that premium. Awesome. I'm collecting juicy premium with someone else's money and the stock is not going to go down. Sure, it's going to go down. Oh yeah, Nvidia's going all the way down to 115. That's why I sold you the $120 put. We look at stocks that we know are going to go up or pretty sure they're going to go up. And as the stock is falling, we get into a cash secured put so that it's near the bottom. So the stock price rejects around our put position and starts to go back up, leaving the buyer in the losing position. 80% of all options expire worthless. Now you might read in certain places that only about 30 to 40% of options expire worthless. And while they're both true, the fundamental fact here is the reason why they say that only 40% of options expire worthless is because the other 40% are buyers that are getting out. They're selling the puts to someone else. So that put didn't expire worthless for that buyer because he sold it to someone else who sold it to someone else who in turn sold it to someone else. But eventually, as sellers, we hold right until expiration if possible. So to us, it doesn't matter how many hands this put changes. All that matters is that on expiration date, it expired worthless. So in that scenario, if we just count us holding to expiration, not how many people are changing hands at the last minute, the last 30 minutes of expiration day, 80% of all options expire worthless. And as the seller, that immediately gives you the advantage. Do you want to stand on the side of the fence where you have a 20% chance of profit or a 80% chance of profit? Do you want to be the buyer with 20% chance of profit or the seller with 80% chance of profit? Oh, I mean, this is a really hard decision. I think I'm going to go with seller on this one. You want to be a seller, 80%. That's where I want to be on this option. I want to be on the 80% side. So I'm going to sell a cash secured put, collect a juicy premium, and then everyone else that's buying these puts are just going to be out of luck. I'm sorry, I'm collecting your money. I'm keeping it, and no hard feelings, but I knew the stock was going up anyway, and I'm just going to take your money and buy stocks with your money. And even if I get assigned, your money is paying for the stock anyway. Sorry. I mean, as the put seller, we have an 80% chance of success, and then in the 20% chance we lose, we're not really losing money. We're just getting to buy the stock, and then we're going to sell covered calls on this stock, collect more juicy premium, and then we're going to exit the stock higher than we got in. So in reality, we're really winning here, right? We're winning big time, guys. Big time. Like, I'm sorry that you guys are buying these options and you're not really winning, but you could come join the winning team at any time. Actually, wait a minute. No. Stay where you're at. I mean, I like where you're at. I like being the seller because, of course, without buyers, I have nobody to sell my options to. So, all right, enough. Just buy the options. I'll sell them. All right, we're good. I'll sell options. You buy them. In all seriousness, you guys can understand how powerful cash secured puts are. Let's dive into the options chain and give you guys some live examples on the chart, as well as the options chain, how you can sell cash secured puts to get into your favorite stocks or collect juicy premium, because there's two ways to do it. Sell the options to make juicy premium, or sell the options to make even more juicy premium, not caring if you get assigned because you really want the shares anyway. So for the first example, we're looking at Wayfair. And the reason we're doing this is because on the 4-hour chart, we can see there's a lot of resistance in this area. So the floor is ultimately $49. And if you really want to be safe and just collect juicy premium, 48 would be safer. However, if you want to collect even more juicy premium, insane juicy premium, you can sell a $49 or $50 put, not caring if you get assigned, because if the stock was to come down to $50 or $49, it's going to consolidate and come back up. Ultimately, looking at the chart, we can see we're at the bottom right now and earnings are coming up. The stock price is likely to go back to $58 in the next 2 to 3 weeks. That means we can get in and then we can start selling $58 covered calls, making $800 on 100 shares, plus all the premium from the puts and the calls. Ultimately, in a month, $5,000 could realistically bring in $1,000 profit, which is a 20% return in 4 to 6 weeks. This is very, very good. So there's two strategies. The I want the shares and the most amount of premium because we know the stock is at a rock bottom. And then there is we want to collect juicy premium, but we don't really want the shares. I'm going to show you both strategies and a very simple trick on how to decipher the difference between want the shares or don't want the shares but want juicy premium. Let me show you the difference. So here we are on the options chain. So if you guys want to learn more strategies just like the one that I'm employing in this video and about to show you, you guys can sign up at investwithcorey.com in the information box below. I would love to be your one-on-one coach and help you guys grow your portfolio and your financial wealth just like you deserve. So here we go, guys. We're going to click on sell. We're going to click on put. We're going to go out 1 week. This is how you determine the difference between just collecting premium or not really caring if you get assigned the stock and you want more juicy premium. If we don't want the stock, we want to sell at a delta around 15 to 20, maybe 25, depending on the volatility of the stock. If the stock's volatility is above 60%, I like to stay around 15 to 20. If it's below 60 or below 50, I like to sell puts around 20 to 25. So in this situation, a $48 put is a 14 delta, and the implied volatility is 56, which means we want to go a little higher to a 49. This is an implied volatility of 55, and the delta is 22. This is perfect if you just want to collect premium. If you want to get into the stock, a $50 put would be better because it's 55 on the implied volatility, and the delta is 32, which if you really want the stock, you could go a little bit higher, but realistically, this is where I would be. $74 juicy premium every week. However, a $49 put will get you $45 juicy premium. So you're collecting almost double the money on the $50 put, but even if you get assigned, it's unlikely for Wayfair to go much below 50. It might go to 49, it might even go to 48, but it's just going to come right back up. And considering earnings is in the next couple of weeks, right around the corner, and we're at a support right now, and the 1-year price target is like $90+, and they're launching their Welcome to the Neighborhood program. Physical stores are going to be opening all over the place. They're really putting a lot of investment money into growing the business. It's highly unlikely that Wayfair is going to go below $50 or $49, and if it does, it ain't going to last but a few days, if that, because right now we're at a floor and the stock price is going up. So that being said, with all of that knowledge, we know that a $50 put is still fairly safe. Even if we get assigned, we want the share. We want these shares, everyone. So we sell the $50 put and collect $74 juicy premium. If we collect this premium 2 weeks in a row, that's $150. If we get assigned and then we sell covered calls at $55, we're now going to make $500 in the shares plus the $150 on the puts, which is $650 plus any premium on the covered calls, which are about the same, give or take. So this realistically could be a $700 to $800 profit in as little as 2 to 3 weeks or a month. That's a lot of premium, and we're doing it the safe way. But on the put side of things, we can sell this $50 put, or we can sell the $49 put so we don't have to worry about collecting the shares. We just collect the juicy premium of $45. And we can do this for several weeks. And then if the price goes up to say $55, $56, we can roll out and up to 51, 52, 53 until earnings time. And then we can just stop. And then we could follow where the price goes. If it drops a little bit, we drop our put and we start selling puts at a lower price or a higher price. But as long as our puts stay around 15 to 20 delta and we keep our eye on the stock price, we're just collecting income every single week without even entering the stock at all. So let's go ahead and look at Nvidia as a second example. We can see Nvidia here is at a high and it's coming back down. So what I would do is wait for Nvidia to either stabilize at 125 and start coming up a bit, or I would be a little bit more conservative and wait for it to pull back to around 124. Once it pulls back to 124, 123, and I see resistance and I see green candles and it's working its way back up again, I'll immediately sell 122 or 120 puts, because now I'm waiting for the stock price to come down. And then once it resists and it starts moving back up, I immediately sell puts closer to the money for more juicy premium, but then it decays and becomes worthless pretty quick. And the reason this happens is because if Nvidia was to come down, say like this, and then it was to come down here and then resist and start coming back up, if I sell this $121 put, it's going to be worth around $250. But then the stock price is on its way up. So when it does something like this within a few days or less, now that put's only worth $100. I've got a 50% return the same day, or maybe in 2 to 3 days. But the idea is to time it so that as the stock hits resistance and starts moving back up, you sell puts around 20 to 25 delta right below where the stock price is. So in this specific example, I'm really looking at 120 to 122, but I'm not going to sell that put until the stock is around 125 or 124, maybe lower, once I see it bouncing off resistance. Click on options, click on sell put, and this works even if you're watching this video in the future. The only thing that's going to change is the expiration date. You're always going to go 1 to 2 weeks out. The most juicy premium. It might look like you're getting more premium because you are if you go out 60 days or even 30 days. However, if you go out week at a time and add up all the premium, it's more going weekly or bi-weekly than it is a month or 2 months out. So in this example, we're looking for a 123 put or 122. More specifically, I'm looking at 122 as this is a 28 delta. This is an aggressive, I don't care if I buy the shares, I want the most juicy premium I can possibly get my hands on. So I'm going to sell 122 and collect $137. But you're probably going to get more or less $200 once the stock price comes down to 124. If the stock price bounces off 125 and starts making its way up again, I will sell a 123 for 170 or 180. So either way, I'm getting closer to $200 per week on these puts. However, if the stock price goes down to say 124 and I want to be safe, or it bounces on 125 and I want to be safe, I'm looking for a 15 to 20 delta. So if the stock price stays stays at around 125, we're probably going to want to sell a 120. If it drops to 123, then we're probably going to want to sell a 118. Maybe less, maybe 119 and 117, because that's going to be like a delta of around 15 to 18. If the price stays at 125 where it is now, it's a 13 delta. Could probably get away with 119 because that's 16 delta. And we really want to watch the delta. If you don't want the shares and the volatility is around 50% like this is, then you could get away with 15 to 20 pretty safe. And if you want the shares or don't care if you get the shares, then 20 to 30 is good, which is why I recommend at the price of 125, sell a 119 or a 120. If you don't care if you get the shares and want more juicy premium, you could sell a 121, a 122, or even a 123. Ultimately, 120 to 121 is the safest bet on Nvidia currently, but remember, this is just an example. This could change at any moment. This is for example purposes. Nvidia is not always going to be in this price range, and 120 is not always going to be a good strike price for Nvidia. This is just for an example to implement on other stocks at different times with similar conditions, which is why I'm mentioning Delta. Delta is key. 24 Delta, pretty aggressive. 28 Delta, even more aggressive. If you're looking to be safe, 20 Delta is even better. So in this situation, we could collect $86 in a safe situation, or we could collect up to $170 to $200 if we don't care if we get put the shares. But even if we were to do this in a safe situation or a safe strategy, we could collect about $90 a week. So if I bust out my calculator, if we collect safe income 4 weeks out of the month, we're generating $350 to $400 a month in cash secured puts. If we get assigned at the end of the month, then we just go ahead and start selling covered calls. We're going to look right here at probably a 22 Delta, and this gives us an upside of $700, which is roughly where it would be, because we always want to be in that Delta range, selling covered calls around 20 to 25, which gives us enough upside to make profits. So realistically, if we do that for 4 weeks, we are going to make about $75 times 4, let's say, $660. So in 2 months, we make $660. And at a 25 Delta on a covered call, we are ultimately looking at around a $4 move on Nvidia. So in this specific example, we'd make another $400 to $500. So in 2 months, we made $1,000, which may not seem like a lot, but that's a 10% return, 5% per month, 10% over 2 months. Very safe and passive income. We could do it more aggressive with the 30 Delta, 25 to 30 Delta, and that would bring us even more profits, probably closer to 15 to 18%, almost 10% per month. So you can see why selling cash secured puts is the safe way to make money. Why be on the buyer's side with a 20% chance of success when you could be on the seller's side with an 80% chance of success, collecting all that juicy premium from the poor buyer and stacking up that cash, so when you do get assigned, you're getting in cheaper with the buyer's money. Then you're getting out at a profit, which is the wheel strategy. That's for another video. But you can see how selling puts is really juicy premium and safe. Thanks so much, guys, for being here. I really appreciate you. Be sure to subscribe and tap the bell so you don't miss content like this, and give me a thumbs up, as it greatly helps the channel grow. Remember, if you guys are interested in bettering your financial health and you want to have more financial freedom, and maybe you're not doing so well in the market, I would love to be your coach and help you out. I offer one-on-one coaching, full Discord, and training course. You guys can sign up at any time at investwithcorey.com, right there on the screen or in the information box below. I go above and beyond for my students, as I truly care and want to help you guys succeed and have the financial freedom that you ultimately deserve. I know this video is over. However, I did pick another video just for you guys, and you're going to love it. And that video is right here. I'll see you over there. Click on it. And remember, until the next video, let's grow our wealth together. Take care, guys. Click the video. I'll see you over there. I promise. I'm over there waiting for you.